What's up, everyone? It's Cathie with MoneyVest. So in this video, we are going to be talking about the warning from Cathie Wood about deflation risk in the economy. And also we're going to talk about the record levels that are being hit in the total assets in money market funds and how there is liquidity once again flooding into the bond market. And I do think that this week might be a little bit of a transition week for yields and of course for equities as well. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like and of course subscribe to the channel. Link to our Discord and Patreon is going to be down below. The first week of the month is the best time to join, and we'd love to have you on board as a MoneyVest member, and you get access to our master spreadsheet which we are working on. It includes our volatility cheat sheet. It includes a lot of technical parameters, including but not limited to our intrinsic values and a lot of other things, S&P 500 valuations and everything that we are going to be adding these multiple tabs on the spreadsheet. So once you join, you will get access to something like this through the link, and you will be able to track every single tab up here. So you can see there's VIX summary, there's a NASDAQ 200, S&P 500 valuation, total assets in the money market funds, which we are going to go over right now. And there will be more tabs, as you can see there are already, and there will be intrinsic values also added. So a whole list of stocks with the intrinsic and the fair value and the difference between them, so that we can make better, smarter decisions. So this right here is the stuff that I just added today. So the current read, as you'll notice, for the total assets sitting in money market funds is sitting at just under $6 trillion. And this is a record level. And this is going back as far as 1940s, right? So 1940s, we're going back for this data. You'll notice that it's been on a consistent increase. We did see a few dips again in 2001, 2002. We did see, money market funds come down, and then a huge spike all the way in 2008, 2007, and then of course a significant decline in 2010, then consolidated sideways for the longest time. But then now when rates are at their highest level in over 16, 17 years, of course, money market funds make a lot of sense because of the amount of rates that they're out there, right? So even Warren Buffett, Berkshire Hathaway, we learned from their earnings report over the weekend on Sunday that they're also sitting at about $157 billion in cash, and a lot of it is in short-term U.S. Treasuries and T-bills. Makes a lot of sense because they are yielding over 4 to 5%. So we are sitting at just under $6 trillion. The median read has been about $1.3 trillion. So we are sitting at over 4.5 times the median number for the money market funds and total assets at the moment. So this right here is what Cathie Wood also mentioned. She says, and I quote, according to the Bloomberg Diversified Commodity Price Index, commodity prices today are where they were 40 years ago and are resuming the deflationary trend in place since 2008. And this chart is nominal, not inflation adjusted. And she goes on by saying that if deflation is a bigger risk today, as we believe, then pricing power will disappear, and big wage hikes will not feed inflation, but will slam margins, and long duration stocks and bonds should be the biggest beneficiaries in that environment. So of course, this has been going on for quite some time from Cathie Wood at ARK Invest. They have been really very macro driven in a sense that they want a deflationary risk. What does a deflationary risk really mean? It simply means that prices will come down to a level where they are going negative, right? Negative means deflation. Inflation is regular price increases. Hyperinflation means rapid price increases. Stagflation means prices staying elevated higher than the Fed's target and staying elevated for longer, so they're not really going higher or lower. They're staying steady at a higher level. And deflation simply means that prices are going down on a year-over-year basis, meaning we are seeing negative prices on a year-over-year basis. And that's going to lead to what? That's going to lead to a significant amount of rate cuts, which obviously will benefit significant long duration stocks. So those are innovation stocks that depend very much on future cash flows. And by future, I mean 5-10 years out worth of cash flows, and long duration bonds as well, as obviously as rates get cut and come down. So that's been kind of like the macro call, but we haven't quite seen inflation come down yet. So of course, Jeremy Siegel has been very much on the same page as Cathie Wood, kind of suggesting there is deflation risk. And Ray Dalio has been more on the stagflation type situation. Bill Ackman's been talking about the economy slowing down faster than what the data suggests. So there is some signals pointing to the idea that yes, there is some softening in the labor market and unemployment could start to tick higher, but economy continues to be strong. And more importantly, consumer spending continues to be very good. And as a result, we're not really seeing any type of deflation risk at the moment. Of course, it could transpire over the next several quarters. Time will tell. But this right here is from B of A. Investors on track to pour $1.3 trillion into cash funds in 2023. This is, again, just a few days ago. And you'll notice that investors are on track to have poured $1.3 trillion into cash funds in 2023. And weekly flows report said that investors put in $64 billion into cash funds in the week to Wednesday, and they pulled $3.4 billion from equity funds across the week while putting $4.5 billion into bonds as well. And bond fund managers are attracting inflows after a brutal 3 years, with many investors hoping that interest rates have now peaked and that yields can fall from here. And that's one of the things that I want to highlight in this example, is that eventually a lot of the capital that's being parked in money market funds, right, and cash funds will eventually find its way over to either the bond market or the stock market. And the way it's going to happen is that first, in my opinion, it's going to kind of move towards the bond market, because a lot of people are going to want to lock in the higher rates for longer, right? Whether it's 5-year, 10-year, 20-year, 30-year, they're going to want to lock in a lot of those rates at those levels, right? And that's going to probably happen when yields start dropping aggressively. Right now, we are seeing this week the yields are pushing back up. So right now they're up a little bit under 2%. And this is kind of like a very strong support, or really a floor at 4.5% for the 10-year treasuries. But the moment we start cracking below 4.5%, it's my belief, or at least in my opinion, or speculating here, that there is going to be some influx of demand in the bond market, which could lead to yields falling further, because demand comes in, prices go up, yields fall, and that's going to create that cycle of panic buying, right? It's actually going to be panic buying, not panic selling this time, because panic buying, so to speak, when yields start dropping, everybody wants to lock in that rate of return very, very quickly. Now, that dynamic could and most potentially will change after a certain level, because right now we're at 4.6%. So on an adjusted, inflation adjusted basis, yields are still positive. So real yields, real interest is still positive right now after adjusting for inflation. But the moment this number drops below 3%, right? The moment the 10-year treasuries drops below 3%, and if inflation stays above 3%, then on a real adjusted, inflation adjusted basis, now it's a negative return. Now we are going to look at the risk premiums, which have expanded as the yields have come down. And that's when stocks become attractive relative to bonds. Right now, the bond market's far more attractive on a risk adjusted basis compared to the equity markets, because yields are fighting for liquidity. And they're at almost 4.5%, 5%, which is exactly what the earnings yield on the S&P 500 is. So bonds and stocks right now, bonds are a lot more attractive on a risk-adjusted basis. But the moment this drops below a certain threshold, then equities will once again regain that risk premium and will become more attractive, so that liquidity can now once again start flooding back in to the stock market as well. So again, a lot of the thesis kind of depends on whether yields roll over or not. Right now, I do feel like this is a little bit of a transitory period. And I say that because we're coming up to this resistance once again, right? 4.79, 4.8%. So what we have witnessed in the last week is that we were making a very nice higher high, higher low. And of course, in the past week, we have seen a breakdown. And if we come back up to 4.79, 4.8% this week or next week's inflation, and then get rejected and roll right back down, then that could be the start or the beginning of a potential downtrend and some liquidity going into the bond market, which obviously is going to benefit TLT, TMF, and some of the other bond ETFs as well. So that's where we are. And equities right now are still consolidating sideways. They're still moving in that downtrending channel. So S&P 500 still getting rejected at that lower high, as we talked about in our previous market updates. NASDAQ also with a red candle, red day. So the rally is coming to a halt right now, which again, no surprises, because we talked about this in our previous videos, but that's where we are. So again, if you want to get access to a lot of these tabs, a lot of these spreadsheets, link's going to be down below, and we'd love to have you on board as a MoneyVest member. Again, if you have any questions, feel free to reach out. As always, happy investing, and I'll see you all in the next video. Let me know in the comment section down below, what do you think about this record money market funds that are sitting on the sidelines, and where do you eventually see this funds flowing over? As always, happy investing. I'll see you all in the next video.